Okay, so right now we're going to go over employment income calculations. So this is like why each number is, how it is, and stuff like that. Okay, so to start off with, employment income is made up of salary plus any bonuses and any commissions that you get. Also stuff like director's fees, like anything to, like stuff that you get from serving on a board of directors. All your normal salary stuff, okay? And then another thing that you have to add in is group term life insurance premium. So there's a whole bunch of like insurance, health, um, premiums, like RPP, CBP, EI. There's a lot of stuff like that, and there's like some different rules for each thing. So we're gonna go over each of them. So group term life insurance premium. So this one is something that the employer pays out of their pocket. It's not deducted from your income like EI or CPP is. So since it's something like the employer gives you out of their like goodness of their heart, this one you have to add it to your income to sort of show that it's like a benefit that you get, which is why it's a taxable benefit. Next one is private health plans, deferred profit sharing plans. Both of these are also things that the employer pays out of their pocket, but for the employer, it's a non-taxable benefit until the amount, it's a non-taxable benefit. For the deferred profit sharing plan, same thing, it's a non-taxable benefit until the amount is actually paid out to the employee, like after like the 5 years that, you've been putting money into this profit sharing plan. When you take the money out, at that point, it would be taxed. But as you're like, any like contribution to this, whatever, would be, these are all non-taxable, which is why like it's like zero to show that it's like sort of like a zero. Like when it comes to like calculating the income, it's not something that you have to consider. Just ignore it. Next is some things we have to go over right now is EI, CBP, income tax. So these things, EI, CBP, income tax. So basically, this salary is like without anything deducted. It's usually just like a whole number. So the salary might be like, I don't know, 90K, and then the EI is like 12K, and then the CBP is like 5K, and then income tax is like 3K. I'm making up random numbers. But anyway, so this would give you to like, I don't know, 64K? I don't really know. But anyway, this gets you to the sum. Okay, maybe it's like some 12,953, 5.4. So actual number, like your actual salary, I guess, that you get would be like 6.4, I mean 64, 260, some kind of like weird number, right? Like it's like a weird number because not like a nice even number like 90K is. Now the thing is, you might be like, oh look, they are taking these three things out of my account. They're taking these three things out of my salary. So like that's something that I can deduct, right? Like I can go to deductions and I can be like, oh look, they're taking this money out of my salary. So like my salary isn't really this, my salary is this, so I have to like deduct those things. But the thing is, you cannot deduct them. EI, CBP, and income tax are things that you just have to keep them in your income. So if you ever see EI or CBP, just leave those alone. Like those things, those have to stay in your salary. You don't really add them or anything like that. It's just like the salary over here will already like include those deductions. So just don't do anything about it. Next one is, all right, so another thing is sometimes you'll be given two different EI values or two different RBP values. Okay, actually no. First we'll go over the EI. You might be given two different EI values. So for example, in this question over here, we're given employment insurance premium of 953 and then employer paid employment insurance premium of 1334. You might be like, what is this even about? So the thing is, you don't actually have to worry about these two numbers at all because these won't factor into your employment income. But just for like general knowledge, I guess, the reason why there's two different numbers is because the number that's deducted from your salary, it's actually less than the number that the company has to pay to like, I don't know, Canada, like the CRA or whatever, or not CRA, some kind of like government stuff, whatever. The employer has to actually pay 1.4 times the amount that's deducted from the employee. So 953 times 1.4 is actually 1334, so that lines up nicely. Another thing is, you might be wondering, why is there two different registered pension plan contributions, right? Like, what is this thing? So over here, when it says the employer paid the following amounts, this means this is something that the employer paid out of their pocket, right? So they were like, yo, like, I want to be a good person, and they decided to take money out of their business to pay for this RBP. right? So it's a benefit, but as we know, RBP is a non-taxable benefit, so you don't have to include it in the calculations. This one over here, this RPP over here, this is the one, this is the RPP that was deducted from your salary, right? So this at the top, they might say something like, oh, like this much was deducted from salary. This was deducted from salary. So what this means is that this one is actually deducted from your salary. And so this one you can claim as a deduction. You can be like, hey, like this amount was deducted from my salary. Can I get the money back? So basically when you go to like your employment income salary, when you do the salary, when you do all the benefits, at the bottom you can go to deductions and you can go to RPP contributions. So this contribution is either employee contribution or employer deducted from their salary. Just anything that it was taken away from their salary, so you have to recognize that, you know, like their actual salary is less, so you have to sort of like account for that. However, if it was this type of RPP, like the one that says like the employer paid, that one means that the employer paid out of their own pocket. I think for the most part though, if there's two different RPPs like in the question, then just like, I mean, they're both the same value, so I guess I don't really know if the value matters too much, but just if one sounds like it was deducted from their salary, that's the amount that you have to write in the deductions. And if there's only one of these, like if they don't have like, oh, this is RBP and this is like, if they don't even have this section over here, like if it's just this part over here, I think for the most part you have to just deduct it from your income because it's sort of assumed that this is something that's deducted, that your employer deducted from your income. But yeah, so that's it for RPP and EI and stuff. So for the most part, most of these life insurance premiums things are all non-taxable, like the private health plans, deferred profit sharing, private medical plan. These are all like non-taxable stuff, except the only thing is group term life insurance. I'm not really sure why, but this is the only thing they have to remember. It's a taxable income, taxable benefit, I mean. So another thing, oh, this is actually a lot. Like, I don't even know if I can get through this really quickly. Okay, another thing is other stuff you have to add to your income is when you're given an unreasonable allowance. So if your employer is like, yo, I can give you like $200 a day, or not $200 a day, $200 a month for any like travel costs. That thing would be unreasonable because he doesn't really take into consideration the fact that I could be driving like this much, or I could be driving like this less. You know, it's just sort of like a general number, like $200. Like, what is that supposed to mean, right? So if it's unreasonable like that, then you have to add it as a benefit, as a taxable benefit. You have to add it to your income. So unreasonable means something like, whereas if it says something like he gets his allowance is like $3 per kilometer driven, in that case it would be a reasonable allowance. It would be like a good allowance, and so it wouldn't be taxable. I don't know why unreasonable benefits are taxed and reasonable benefits aren't. I think it's because this benefit over here is taxed. Because the thing is, if it's an unreasonable allowance, then you would include it here as a taxable benefit, but then you could deduct from deduction stuff like automobile or like travel costs, like any like automobile travel expenses. Whereas if it's a reasonable allowance, then oh, actually, hold up. And if it's a reasonable allowance, then you wouldn't do that. I don't know what would happen if you don't. It's not reasonable. I don't know if it's reasonable. I know you wouldn't include it here, but if it's a reasonable allowance, would you include it anywhere else, or would it just be like a non-taxable benefit? I think it would just be like a non-taxable benefit, and you wouldn't like include any other like costs here, like any of the other expenses that you take on since the employer sort of pays for it, I think. But yeah, that's that. Another thing to include is club dues. Like literally any club you're a part of, you have to include it. Okay? Wait, what happened to the rule? Is that only for like salespeople or something, or entertain clients? Okay, what? Okay, just any club dues, no matter what, like golf clubs come up all the time. Those things are bad, okay? Like if somebody like tells you, oh look, we got you like a free golf club membership as part of your work benefit, that's bad because you're gonna have to tax it. That stuff is always taxed. Another thing is you're going to have to add any standby and operating benefits. So these are from cars, okay? So basically, so if the employer gives you a free car, the employer gives you a car, and they're like, hey, like you can use this for free. There are two sort of benefits, like two sort of expenses that they pay for you. One is a standby charge and one is the operating benefit. The standby charge is sort of just like how much does it cost, like how much does a benefit actually cost. Do I have the amount here? Oh, I do, yeah. Oh, that's what the blue is for. Okay, so there are two benefits that you have to like, that you sort of get from the free car, and those two are taxable benefits you have to include. So, first of all, a company provided car has taxable benefits. So, the standby charge, okay, so if the car was purchased by the company, so whether the car is purchased by the company or leased by the company changes the amount of benefit you have to pay. So if it's a purchase by a company, then the standby charge is 2% times the cost of the car times the number of months that you used it. So like, for example, if you got the car in like July beginning, then it would be like July, August, September, October, November, December. So 6 months would be used. And then the operating expense benefit is just like how much have you used it. So it's just like 0.29 times the personal kilometers. So this one's sort of like how much benefit do you get on like a personal basis, right? Like, so you get to like, how much do you get to use it for like your own personal uses? So it's like 0.29. All right, this is 29 cents by the way. That's why I wrote 0.29. It's 29 cents per kilometer that you've driven. Okay, the next one is if you're given a free company car and it's leased by the company, then your standby charge is different. It's 2/3 times the, oh no, okay, 2/3 times the monthly lease times the number of months it's used. Same thing over here for the number of months used. But just like this thing sort of calculates the entire annual lease. Like for this entire year, how much lease payments have you paid? And you have to multiply that by 2/3. So if a question were to tell you if the question were to tell you the company makes lease payments of $6,000 per year, that means that your taxable benefit is 2/3 of that, because it's 2/3 times the total lease payments. And the operating expense benefit is also the same thing, 29 cents times personal kilometers. Okay, another thing is for both of these, if the amount driven is mostly for employment, like they were like, oh, like if you use like you would drove 12 kilometers for employment purposes, 8 kilometers for personal purposes, then you can reduce the amount by this sort of factor, by personal kilometer over 1,667 times the number of months used. So the thing is, this thing is going to be like less than 1, right? Like it's going to be like a small number, which means that when you multiply your standby charge, wait a second. Yeah, you can only reduce the standby charge. It's only for the standby charge, not for the operating expense benefit. You can reduce the standby charge by that amount to show that you're not using it that much for your personal use. And it's not really like a personal benefit, it's more like an employment benefit. So this sort of does that. Okay, actually, look, if the personal kilometers was actually 0, then this entire standby charge would be 0, right? Damn. But I think you'd have to use some personal kilometers though, so like that would never like be a thing. But it's just like you could technically like you could sort of in a way maybe pay standby charge. But I think one thing is that like for example traveling from your home to your workplace counts as a personal charge. I'm not sure why it's a personal kilometer. So like you would in some unless you like never work at the company and you like only ever go to like some like other like place, I guess. In that case, like it's possible that you could only your personal kilometers could be 0, in which case this thing would completely be 0. That'd be cool. But anyway, that's that. So these are both like the employer gives it to you free, so you get a benefit. Okay. This is different from when you use your own car. When you use your own car, you have to deduct them as expenses. So that's one thing that I was confused about actually, because I was like, how come sometimes it's a taxable benefit and sometimes it's a deduction? Taxable benefit is like when you're getting something free from your employer. So you have to be like, oh, look, they're giving me this benefit, I have to add it back. Whereas deduction means, look, I'm using my own car and I'm using my own expenses, my own like money to pay for fuel, all that stuff. And so for that, I have to be deducted from my income to show that I'm like paying a lot of expenses for my work. Let's see, that's that. And then let's see, income from stock option. This is also something that goes under employment income. Is it? Yeah. Wait, is it? Yeah, it's also one thing that goes under employment income. And any stock option deductions, like if the stock option was like out of the money, and so you got like a 50% stock option deduction, that one is included here. It's included in other deductions. That is not here, by the way. So we're going to go over the aggregating formula. So to start off, there's employment income, which is the one that we're working on calculating right now. The salary, allowance, deductions, everything. All these deductions also, like, remember, all these deductions add to your, or like they subtract from your employment income. And then you also have business income, property income, other income, capital gains, and other deductions. This deductions is different from the deductions that go under this employment income. That's different. Okay, so that's just something else to keep in mind. Blah, blah, blah. So these deductions are all like employment income deductions. So first of all, we have RPP contribution, which I've already gone through. This is money that's taken out of your salary. So you have to be like, yo, like they're taking this out of my salary. Can you like sort of like, you know, make sure that my income sort of reflects that. My employment income reflects that. Another thing is office supplies. Anything that's used for the office, like you can deduct it. Private medical plan, employee paid. So remember, this is like an employee paid plan, so it's taken out of my salary. So this one is also deducted. Internet access fees at home. So if I pay a lot of internet for my workplace, then I would have to deduct this. Also, it's prorated. So like if I only use like 30% for work, like 30% of the internet is for work and 70% is for like personal reasons, then it would be 30% times the internet, total internet value. Association fees. So if I was part of like some kind of, I don't know, accounting association, like engineer association, and I had to pay that in order to work, those I would also deduct those. Union dues, those are mandatory. I have to be sort of, I'm sort of like part of the business, part of the company, so I sort of have to pay those. Phone plan. So the one thing is, if you buy a phone, the purchase of the phone itself is not deductible because that's a capital asset and that has different rules. But for a phone plan, like for example, like $20 a month for like basic like talk and text, whatever, that stuff you can deduct, and that stuff you'd also like prorate. Like I think the prorating is sort of like just like on like a, just have to think logically. Like, are you using it like fully for work? Like, can you just be like, oh, like look, this is all for my work purposes? Then no, you have to like prorate to make sure it's only for your work purposes. Another thing, CCA, lease interest on automobile. Is this either gonna be CCA and interest for like interest on like a loan to like buy a car, and the CCA to like sort of like depreciate the car, or it's gonna be the lease, like if I'm like leasing a car. So this one over here is if I'm using my own personal vehicle for work purposes. In that case, I can deduct some of that, deduct however much I am using for work purposes. Like for example, remember the whole like I'm driving 70%, I'm using the car 70% for work, 30% for home. We would prorate that to show that it's like this is how much that's applicable to like employment income. Another thing is there are other home office expenses. So these are, so you can only deduct these expenses if you work 50% or more there. So if you're working, like if you're just like taking home work, like to work on the nights or whatever, that's not really like a thing. If you work at your home maybe like 3 days out of the 5 days of the week, then you work 50% more there, and you are eligible to deduct this. So if the question were to be like, oh, like you work like, you know, like a couple of hours at home, and this is how much of like the utilities you use, maintenance use for like your work purposes, you can't do that because you have to remember it's only if you work 50% more there that you can even think about using any of these. Okay, so things that fall under this are utilities, maintenance, and rent if you like if you're renting a house. Okay, cool. I think I've gone through those. Cool. Net income for talks. Yeah, I mean, that's kind of whatever. Okay. One thing that's sort of big is the salesperson expense, 81F, and the 81G and G.1 travel and automobile expense. First of all, these two types of expenses can only be claimed if there is no reasonable allowance. Remember over here, if over here you have an unreasonable allowance, so you're adding to the tax benefit, like you're adding to your income, over here you can then deduct from your income like your actual expenses, stuff like that. But if you're given like a reasonable allowance, remember like an allowance that says like $3 per kilometer driven, in that case you cannot deduct it. Okay, so that's that. I'm gonna go over this like a bit more detail. I don't know when. Let's see how much there is. All right, okay. Also, another thing I forgot about this one is if you own your own car, either CCA plus interest, like you own your own car, or you're leasing a car, there are also limits for those, like limits for like the number of deductions you can do. So if you pay lease payments, then your maximum lease payment you can deduct is $900 plus tax. So if my lease payment was like $1,000 a month, and like I use it for like the whole like I don't know, like say I use it for like 6 months or whatever in a year, like from June to December, I can only deduct 900 times 6, 900 plus tax times 6. Another thing, so like even though it's higher, even though like my actual expense is higher, you can't deduct too much. Another thing is if you pay interest on a loan to buy the car, that interest is limited to $300 per month. And if you're to show like depreciation of the car, if you're using CCA, like you have to use CCA, the max cost of the car you can use is $34,000. So if your car actually costs $37,000, you can't use that full amount to deduct. You have to deduct a maximum of $34,000 plus tax. This one comes to like around like 38,400 or something like that. I'm not too sure, but yeah, that's like a limit. Okay, these two over here are okay. The Commission 81F and 81G. Those are like honestly like the most confusing things, just because there's like a lot of stuff. If like remember that. Okay, so first of all, okay, I think that's the last one. 81F stuff. Also, another thing is so if you have any personal like stock gains, like stock option capital gains, you have to remember that that does not fall under here. It falls under this taxable capital gains. Okay, so that one and that one is taxable at 50%, not fully taxable. So you'd only take like 50% of your gain and include it to your like total addition, whatever. Okay, so now we're gonna go over the 81F, that stuff, the confusing stuff. Yay. So to start off, we have, so if you are earning commission, like let's say normal people, you get like a salary, right? Like every week or whatever, you get like a check with like some money, right? But a commission employee, you might get like a salary, or I mean, you might get like a salary. Okay, instead of a salary, you would get something that's like a percentage maybe of like sales. Like maybe you get like a commission that's like that says, oh, like however much sales you make, that's how much your salary is, or like, you know, like depending on how good you are, that's how much your salary is. Like it's not like a fixed amount, right? Like it's like a commission, like based off of like your number of sales or something like that. In that case, if you are earning a commission, you have the option to deduct under a different rule. Sales expenses 81F. As a salesperson, you are considered a salesperson. So, some sales expenses that fall under this salesperson rule are ad and promo. You can deduct these fully. So, for example, any like pens that you buy, any like I don't know, paper that you buy, like advertisements that you make, those are like you can fully deduct them. Meals for yourself, these ones you have to be outside a metro for 12 hours in order to deduct these. Like outside like a metropolitan big city for 12 hours to deduct these. Next is if you're entertaining clients. So for example, you take a client out to like eat whatever. In that case, it's also 50%. If you take them to like, I think if you take them to like a hockey game, for example, I think that's also like considered part of entertaining clients, like as long as like with a client, so that's also 50%. Let's see. Another thing that you can write off under sales expenses are leased computers, phone, and equipment. So if you lease any things, then all of your lease costs you can include. But obviously they have to be prorated to like how much you actually use for the company versus like your own personal uses. One thing is if you purchase equipment, you cannot deduct that. Like if you're buying like a phone, you can't really deduct that. You can only include leases. Because remember, purchased equipment is like CCA, not CCA. It's capital asset, and that would be treated differently. It's not like an expense. You would like, if it's a car, I think, if it's an automobile or a plane, I think, you can deduct CCA. But for anything else like computers, phone equipment, you cannot deduct CCA. So these ones, it just kind of sucks. Like you just have to like accept the fact that you can't really get money back for the purchase you made. Another thing is motor vehicles. So motor vehicle expenses like fuel, repairs, insurance, license, CCA, interest on the loan, blah blah blah, lease payment if it's leased. That type of stuff also falls under sales expenses. One thing is the interest on loan is limited to $10 times the number of days or $30 times the number of months, right? 30 times 12. Yeah. So the thing is, I think the official term is $10 times the number of days, but like for us, like in our class, we're just doing 30 times the number of months, whichever one's easier, that works. Is that also the same as, never mind, that's different. Oh, wow. Wait a second. See? Look over, is it really 30? 10 times 365 is 3650. 30 times 12. This, I think this is 300. 30 times 12 times the number of months. Yeah, bro, it's supposed to be 300. Oh my god. 300 times the number of months. Because it matches up with this one over here. If you use your own car for work purposes, this is the limit of the interest you can deduct. Also, same thing over here. Like if your lease payment, CCA, these things also have these like exact same limits. You have to like remember that. So these are the things you can deduct under sales expenses. Okay. One thing is that your sales expenses have to be limited to your commission. Like if you're earning a commission of $6,000, you can't be like, oh, my sales expenses are 9K, so like I get like a loss of like negative 3K. That's not allowed. The maximum deduction, maximum sales expenses you can get are 0K. 0. This is why it might sometimes be beneficial to, instead of deduct as a salesperson under this rule over here, 81F. 81F, I think that's just like a name of like a rule in the Income Tax Act. But instead of deducting as a salesperson, you can deduct as a salaried employee and just deduct your travel expenses and your motor vehicle expenses. So over here, same thing over here, travel expenses are food, beverage, clothing, blah, blah, blah. For food and beverage, you have to be outside the city for 12 hours. I'm pretty sure this one is 50%, is it not? Like, why doesn't it say that? I mean, I'm pretty sure this has to be 50%. So yeah, I'm trying. Okay, I'll just make sure it's 50%. But anyway, these ones you can deduct 50%. Again, the food and beverage has to be outside 12 hours of the city. Lodging and transportation. This transportation is other transportation that's not like your own car. Yeah, lodging and transportation, if you pay your own expenses and you didn't get like reasonable allowance. Again, it's like the whole reasonable allowance thing. Okay. So for a motor vehicle, it's like the same thing as if you're like a salaried employee, and the interest on loan is also same thing, limited. Oh, I have to make sure it's 300 times the number of months, right? Yeah, it makes more sense because it would be way too much. Anyway, this is the expenses you can deduct as a salaried employee. Now, you have to remember, you might look at this and be like, oh, look, you can deduct way less here than you can here. So this should definitely be higher, but you have to remember that this is always limited to your commission. So if your commission is low, then this might not, you won't be able to deduct this entire thing. Whereas this one has no limit. So like, if you're gonna be like, oh, like if your commission is 6K and your expenses are 9K under this 81F, like including all these expenses, and your expenses under this salaried employee thing is 8K, then I would go with this one, because for here, you would have to include, like, you're limited to the 6K. You can't deduct more than that. So that is one thing over there. Right, so the sales expenses won't always be higher because they're limited to commission. Is that it here? Okay, nice. Oh boy, okay, so some things that fall under other income. Actually, no, I'll do this one first. Okay, so one thing is not, you might be like, oh, like wait a second. Okay, actually, this might actually confuse you, so like I would suggest like skipping this if you're like cool with it, whatever. But things for me is there are certain things that are limited to the commission, like limited to the 6K commission or like whatever commission is. And there are some things that you don't have, they're not really limited to it. So for example, any travel expenses, meals, motor vehicle, advertising, promo, meals and entertainment to entertain the client, property taxes, insurance, home office. So one thing over here is, remember up top where we said that if you worked from your home more than 50% of the time, you can deduct all these expenses. One thing about being a salesperson is that if you're like a commission employee, you can also deduct your property taxes and your insurance home office. You can't do this if you are a normal employee. But yeah, so only for commission employees. Now, one thing that's not like limited to the commission is if you have to pay CCA on the vehicle or interest on the vehicle, because these things have their own limit. I don't really know why they're not limited, but one thing, like one way to remember like which things are limited to the commission, like basically, okay, what this means is like, let's say that your commission is 6K, and let's say that all these expenses add up to 7K. No, let's say like all these expenses, they add up to 5K. Over here, we have things that are not limited. So let's say that this thing over here, this adds up to a cost of 1.2K. Now you might be like, oh, this means that this is, wait a second. It's kind of a dumb question. Okay, you might be like, oh, that means that, my total commission is like 6.2, but it is limited to 6K, right? Wait a second, what? Okay, actually, so one thing is that the things that are limited to the commission are also just things that you have to include over here as part of sales expenses, right? Or motor vehicle expense. Do you get those like either way? Whoop, whoop. So this one over here, these three over here, whether you include this or not, depends on whether you're deducting as a salesperson or a travel and automobile, I think. Jeez, what the hell? Okay, I'm actually kind of confused now. Things that are limited to the commission. So just something to remember is that things that are limited to the commission, they fall under the salaried travel expenses, so like all these things, plus things that only commission employees can receive. So for example, one thing that doesn't fall under the limit is, stuff like normal home expenses, like these like normal, like the other office home expenses, because why? I don't know. I don't really know why. I think it's just to show that this is sort of like special to the commission people. So it's just stuff that something that salaried people can get, plus anything that only commission people can get. So just to show, I don't know. I mean, I don't know. Like if you think about it, I guess it sort of makes sense ish. But yeah, so some things that don't limit to the commission are the CCA motor vehicle and the interest on the loan motor vehicle. So what these ones are sort of deducted or sort of like added outside of the whole 81F salesperson expenses. Like these guys can be over here like by themselves, whereas the salesperson expenses don't really have to include those. Like don't really have to include the CCA and the interest, I think. Also, like I found this online. I'm not really sure if this is like accurate, like according to like what we've learned. But anyway, these ones, so if you have CCA on some motor vehicle and some interest, you don't have to limit to the commission, I think. Like when you're when you decide that, this commission over here would be total of 6K due to the limit, because you're adding CCA plus interest over here. Okay, hold on. Okay, I'm gonna do this right now. So let's say commission equals 6K. Okay. My term deductions under 61F, 61G, and G.1 or whatever. 8? I don't know. Oh, it's 81F. Okay, 81F. Whatever, doesn't really matter. Anyway, all my salesperson expenses includes like my ad and promo, meals, blah blah blah, and it also includes CCA. CCA, and also includes interest. Let's say that this expense over here is 5K, this one over here is 1.2K. Let's say that if I were to deduct underneath this section over here, my deduction would be my total expenses when you add up all the travel and automobile expenses is like 5.5K. Now, okay, right now, over here on this side, you might think, okay, so it's 5 plus 1.2, so 6.2, but it's limited to 6, right? But that is not true, because these two things over here do not factor into the limit. So your actual, so would you do 6.2 then? Okay, I'm actually confused. Right, yeah. So in this case, what you would do is you would deduct 5K under sales expense, and then the other 1.2 under like CCA and interest, just like as part of like a general thingy, like just like a general thing here, CCA, lease and interest on automobile. If you were to deduct as part of the G&G point 1, where you have your automobile and your CCA and interest, and all that adds up to 5.5K, this thingy, this here you can deduct 6.2, whereas here you can deduct 5.5. Which one? This one is higher, so you can use this, okay? However, one thing is if instead of CCA and interest, instead of like buying a car, you leased a car, and the lease was, let's say, like 1.2K, in that case, this thing would have to be included. So your total income would be 6.2K, limited to 6, whereas here, your total expenses is 5.5. This is including like the lease cost too. So like, I mean, okay, so this, I feel like my example right now is kind of dumb because like either way you have to go with the salesperson because it's higher. But in like, let's say that it was like 6.1. Let's say that this expense was 6.1 over here, whereas this one, in option number 1, with a CCA and interest, you would have gotten 6.2, whereas with the lease, you would have gotten 6K. In this case, with the lease, I would go with this one over here with the travel and automobile expenses. Whereas if you were doing it part of salesperson, you would go with, whereas if you're doing like CC and interest, you would go salesperson. I don't know if this makes sense, but like, I mean, kind of does-ish. Okay, another thing is there are two types of, other than the employment income, these two things are sort of like other income that sort of like pop up sometimes. EI collection. So if you're like unemployed and you like collect on your EI, that thing would go under other income. Another thing is any like retirement income, that would also go under other income, so like pension payouts too. And that would go in the aggravating formula. It would go over here, other items of income. Another thing is other deductions. Remember, this one over here, other deductions, is different from the deductions under the employment income. This one goes in a different section. This one has stock option deduction and moving expenses not reimbursed by the firm. So if you go here, that one is over here. So stock option deduction and moving expenses not expensed, not reimbursed by the firm. So let's say like you have to move or whatever, and the total cost is like, I don't know, 60K, and your firm gives you like 40K as like a sort of reimbursement. The other 20K can go under here. I think there are like some rules as to like when you can like take care of them, like when you can like ask for them. But for the general idea, like other deductions, that's one of the other deductions. I think that's it there. I think that's it.